5 months ago this week, I invited some good-natured mockery by warning people that the only way to survive the looming economic crisis was to take a large notepad and go and watch The Revenant. We'd all be living in the wilderness soon enough, so it was time to learn how. Well, I didn't go quite that far, but I did state my profound belief that this crash would be much worse than the 2008 banking crisis, and, given how close we came to the collapse of the financial system then, it's a reasonable fear that we won't get so lucky twice. Back in August, the Chinese government and the U.S. Federal Reserve combined to kick the can down the road, as they have done many times before. But now here we are again. The can looks more like a boulder, and even George Osborne has joined the chorus warning of risks ahead. Whether or not a crash is imminent, let alone one on the scale I fear, remains deeply uncertain, but the one assumption I have up to this point considered safe is that the beneficiaries in political terms would be on the left. George Osborne warns UK economy faces cocktail of threats. Read more. My reasoning was that if, for the second time in a decade, the economy crashes because of loose lending, bad investment and laissez-faire government, the capitalist model that survived the 2008 crash unscathed would finally be ripe for upheaval. In that case, I believed, Jeremy Corbyn, Bernie Sanders and other leftist candidates around the world might get the mainstream hearing they are currently denied. Now I'm not so sure. When I look at the U.S. voices who have shouted longest, loudest and most persuasively about the current economic bubble, from young market analysts such as Jesse Colombo to old hands such as David Stockman, as well as politicians such as Ron Paul and Donald Trump who have jumped on their bandwagon, they could not be further from the left. In their minds, what we are seeing now is not a further repudiation of the capitalist economic model, but proof of what happens when market forces are not allowed to operate freely, and where governments and central banks see it as their role to prop up markets and keep the bubbles growing. In other words, if we'd stuck to libertarian, free market, sink or swim economic fundamentals, with a dash of isolationism thrown in, none of this would be happening. And it follows that the very last response to any crash should be more of what they depict as the state-controlled, debt-fueled pump priming of the economy that has got us into this mess. No wonder Trump wants the bubble to burst before November. How he would relish depicting Hillary Clinton as the status quo candidate in those circumstances. George Osborne's cocktail of threats will leave us with a hangover. John McDonnell. Read more. In Britain, Corbyn's ability to capitalize on a new crisis should in theory be easier. Against a government that has feet-sheet austerity, relaxed controls on the banks, and bet the farm on continued Chinese prosperity, Labour's alternative must surely appeal. But what if the Tory right beats him to it? After all, if a crash does occur, Theresa May and Boris Johnson will need to differentiate themselves quickly from George Osborne's economic policies. So why not follow the lead of their American colleagues and start now? In 2008, given the scale of the crisis the world faced, no one could sensibly have argued against the case for government intervention and stronger curbs on the banking system. Next time round, the debate will be very different. Will everything be blamed on the excesses of the market, or the market not operating freely enough? Will the answer be an even bigger role for government, or government learning its lesson and getting out of the way? Who wins those debates will have a huge impact on how people vote at the next elections in the US and Britain, and whether we lurch to the left or the right. BlackRock's Larry Fink says negative interest rates are biggest crisis in the world. Fink joins bond guru Bill Gross in criticizing central bank policies. BlackRock CEO Larry Fink on Thursday called negative interest rates the biggest crisis globally, warning that they are hurting savers, retirees, pension funds, and insurance companies. Fink's comments on CNBC echoed views expressed recently by bond guru Bill Gross of Janus Capital Group, who claimed that negative interest rates in Europe and Japan could roil the global economy by upending the business model of the banking sector. Gross went as far as to claim that bond investors that buy bonds with negative yields are thinking and managing assets at the grade school level, as they do not understand the absurdity and consequences of negative bond yields, when an investor pays money for the privilege of lending it to governments. On Thursday, BlackRock's chief took the argument a step further, calling ultra-low rates in the U.S. and negative interest rates overseas the global crisis hurting pension funds and insurance companies, which are unable to meet their liabilities, as they are receiving anemic returns on their bond investments. Over 70% of our clients are retirement plans and insurance plans. Our clients are in pain, Fink said. His comments came as BlackRock Incorporated, BLK, plus 1.90% reported Thursday net profit in its latest quarter fell mainly due to market-driven lower fees. The world's largest money manager said it was restructuring in the quarter in a move to streamline and simplify our organization and drive efficiencies. Fink blamed the poor results on market volatility. When you think about what happened in the first quarter, the markets fell double digits, Fink said. When you have that type of volatility, you have uncertainty from our clients. The clients are pulling back. Talking about central banks' efforts to spur growth, Fink said that monetary easing, once presented as a temporary measure, has turned into the new normal. I don't call 7-8 years temporary. I don't see how that still has a positive impact, he said, adding that global markets have become too dependent on central bankers to boost the global economies. To make matters worse, those policies have the opposite effect on the economy than intended, Fink said in his annual letter to shareholders published Sunday. Instead of monetary policy, Fink called on political leaders to step in and provide fiscal reform, echoing the views recently expressed by Goldman Sachs CEO Lloyd Keene, who said he sees room for continued fiscal policy expansion to deal with the potential of economic slowdown in some economies. In his letter to shareholders, J.P. Morgan Chase & Co. Chief Executive Officer Jamie Dimon also expressed fears in March that negative interest rates could have a lot of unintended consequences that we don't understand. But last week Dimon said he isn't worried that U.S. policymakers might resort to negative interest rates, citing the healthy labor market and growing consumer strength. Washington, April 11, 2016. Amid falling commodity prices and continuing weakness in global growth, Sub-Saharan Africa's gross domestic product (GDP) growth decelerated to an estimated 3.0% in 2015 from 4.5% in 2014, according to the latest World Bank projections. This low pace of growth, which translates into an increase in the region's GDP per capita of less than 0.5%, was last seen in 2009 following the global financial crisis, and contrasts sharply with the robust 6.8% average annual GDP growth in Sub-Saharan Africa (SSA) from 2003 to 2008. These latest figures are outlined in the World Bank's New Africa's Pulse, the twice-yearly analysis of economic trends and the latest data on the continent. The analysis shows that the slowdown comes amidst a sharp drop in global commodity prices, weak global growth that was underpinned by a slowing of growth in emerging market economies, including China, and volatile financial markets. The fall in commodity prices represents a significant shock for the region, as fuels, ore and metals account for more than 60% of the region's exports. The impact is seen most in oil-exporting countries, where average growth is estimated to have slowed from 5.4% in 2014 to 2.9% in 2015. Growth fell sharply in Nigeria, the Republic of Congo, and Equatorial Guinea. Activity also weakened significantly in non-energy mineral exporting countries, including Botswana, Sierra Leone, South Africa and Zambia. In several commodity exporters, adverse domestic developments, such as electricity shortages, severe drought conditions, policy uncertainty, and security threats, exacerbated the direct impact of declining commodity prices. There were some bright spots, mostly among oil importers, where economic activity remained robust. Côte d'Ivoire saw broad-based growth, supported by a favorable policy environment, rising investment, and increased consumer spending. Ethiopia and Rwanda continued to post solid growth, supported by public infrastructure investment, private consumption, and a growing services sector. Elsewhere, growth remained buoyant in Kenya, amid improving economic stability. Tanzania registered strong growth, underpinned by expansion in construction and services sectors. Africa's Pulse finds that the recent commodity price drops have deteriorated the region's terms of trade in 2016 by an estimated 16%, with commodity exporters seeing large terms of trade losses. Some 12 countries, housing nearly 36% of the region's population and representing about half of its economic activity, are considered vulnerable in terms of trade losses that are expected to exceed 10%. About 17 countries with more than 25% of SSA's population fall into the group of countries with terms of trade gains. With commodity prices expect combined to kick the can down the road, as they have done many times before. But now here we are again. The can looks more like a boulder, and even George Osborne has joined the chorus warning of risks ahead. Whether or not a crash is imminent, let alone one on the scale I fear. "5 months ago this week, I invited some belief that this crash would be much worse than the 2008 banking crisis, and, given how close we came to the collapse of the financial system then, it's a reasonable fear that we won't get so lucky twice." Back in August, the Chinese government and the U.S. Federal Reserve remains deeply uncertain. But the one assumption I have up to this point considered safe is that the beneficiaries in political terms would be on the left. George Osborne warns UK economy faces cocktail of threats. Read more. My reasoning was that if, for the second time in a decade, good-natured mockery by warning people that the only way to survive the looming economic crisis was to take a large notepad and go and watch The Revenant, we'd all be living in the wilderness soon enough, so it was time to learn how. Well, I didn't go quite that far, but I did state my profound